Ahoy there, traders. How are we all doing? Welcome, welcome, welcome one, welcome all. We're live. We're recording. Hello. Adrian, Gerard, Glenn, hello. Good morning. Ian, Mark, Randall, hello again. And Vito, not forgetting Vito. Can't forget you. Hard not. Right. So let's get cracking. I thought we'd revisit a concept, 6 trends. We generally talk about them every week, but I want to really stress the trend this week. And it doesn't matter whether you're a trend trader, a range trader, a counter trend trader. You need to know what's going on so that you know what to do next. And it's a really simple concept, and very few traders do it. And if they do it, they don't do it right. And it's not difficult to get it right. It's just you need to do it in the first place. So I thought we're going to be discussing as the kind of the main thrust of what we're talking about. This week, I see everyone's logging in slowly. Hello, everyone. We've got, again, Chris joining us, Mark, another Mark. Martin, hello. Hello, Rob. How you doing? So everyone's just coming in slowly. Pop a comment in the chat box. What have you been up to this week? Have you been doing anything interesting? 6 trends every trader needs to know. There we go. Right, so 6 trend blueprints that every trader needs to know. For those who are new, the way that these sessions normally go, we're going to be spending about 20-30 minutes and up to about an hour, usually about an hour. We'll be looking at the markets, specifically we'll be looking at trends that every trader needs to know. Again, there shouldn't be anything revolutionary about this, but again, I just want to stress, like, very few people actually do it, and people wonder why they're not seeing the success or the results that they're expecting. And this is a really simple fix. And it doesn't matter whether you're using my strategy or someone else's strategy. You can add this into your current trading routine very easily, so that you can start to improve the success rates that you're seeing, or maybe start seeing the results. Just adding this into the mixing pot. I've seen it turn break-even traders and loss-making traders into profitable traders just by looking at the fucking trend. It really is simple to do. Anyway, for those who are new, my name's Phil Newton. I've been trading full-time for a wee while. I've coached thousands of students with my programs all around the world, from banks, hedge funds, institutions, and the little guy like you and me, the retail trader. I've got a little bit of a picture missing there. We'll fix that later. I love a good read. Read on a ramble is my kind of thing to do at the moment. I'll spend most days going for a walk around town. I'm not a Wall Street guru. Oh, where are all my photos gone? I'm not a Wall Street guru. There should be a picture of Wall Street person there. Everything's breaking on me this week. I am just a regular guy. I do these sessions because I enjoy doing them. I do have programs for sale. I do help people on a more personal level. But, most people get good success just by knowing that it's possible, knowing these little tips and tricks that we go through every week. So what I try and do is every week I try and be your personal guide along the murky waters of the markets. And every week I do these insider little info sessions, workshops, so that you can become a little bit more profitable and work towards seeing your own successes. I know what I do works, and I've got a systematic approach to find, filter, and sort stocks. It's easy to follow, it is profitable, and you don't have to take my word for it. I've got plenty of student successes and results over the decades that illustrate this. So it gives me time freedom. Specifically, it gives me financial freedom. That's what I'm looking for. I noticed the sequence there. Time freedom for me right now is probably the single most important thing. I do not want to spend every moment of the day flicking through chart after chart after chart. That is such a bad use of anyone's time. And to be fair, it's the same with anyone, any career choice. You don't want to be stuck in the mundanity of, or the minutia of, just doing those repetitive tasks. what we should be able to do is zero in on the best opportunities every day. I often refer to what I do as a production line because I want it for me first. And selfishly, all of this is for me first. It's just that you get the benefits of the fruits of my labor. I get to, as I mentioned earlier, I get to ramble around the place. Interesting things and places that I found this week. I found some wonderful artwork just noodling around town. I'm an urban tourist at the moment. I found some lovely artwork. If you like graffiti, great. If you don't, tough. It was just interesting and eye-catching. I also recently found a monument to a Victoria Cross winner. Again, I'm a little bit of a like my military history. If you're not in the UK, the Victoria Cross, sorry, if you're in the US, it's kind of like the Medal of Honor if you're in the US. I know most people are in the US, but whatever the top military achievement is in your country, the Victoria Cross is what it is in the UK. The Medal of Honor is what it is in the US. And there's just a surprising little monuments dotted around Liverpool. We actually have quite a few Victoria Cross winners, and this was just one of them that just caught me by surprise. I walked past it so many times, I've never noticed it before, but I just stopped to admire it, and it was just a nice little thing. I ultimately go past a place called Shavas Park, who's a double Victoria Cross winner. So imagine winning the Medal of Honor twice. That's kind of what it is, and we've got Liverpool's got a rich military history. So that was just interesting things that caught my ramble. I get that time freedom to go and do that things, and I've got to admit it is because of the stock market. I'm very fortunate to have made it work for me and made a career from it. It's not just something I do on the side. I went full-time trading back in 2001, and again, I am very lucky to do that. And again, it just reinforces that's one of the main reasons why I do this, so that you can benefit from the fruits of my labor. Anyway, the biggest revelation after all my little ramblings is to one of the bigger revelations is the trend. It is the trend. Yeah, Zigo, just picking up on some of the comments, double Victoria Cross. It's actually Noel, I think it's Captain Noel Shavas. It's got a funny sounding name, but yeah, double Victoria Cross winner. And just the story behind most of these medal winners, whether it's a UK Medal of Honor winner or Victoria Cross winner, or the US Medal of Honor winner, or wherever you are in the world. I appreciate everyone's like different countries around the world. But some of the stories behind these things, I'm not trying to glorify them, but you're kind of like, we're here today because they gave their lives, they put their lives on the line. So I do have a lot of respect for people who put time in the military, but at the same time, you want to be thankful and trying not to cry and hold back the tears, because what it represents, it's a double-edged sword when it comes to the emotional responsibility of kind of thinking about these things. Anyway, before I kind of go down that rabbit hole, we're all here for the stock market. Yeah, absolutely. Yeah, Ezekiel, you got to pay respect where it's due. So trend trading, easy to do, difficult to put into application. So most people think. So they end up skipping this. And if they're trying to trade the trend, they do it wrong. And what I want to try and do today is just spend a few minutes, and we go through trend trading every week. I go through the primary blueprint that makes me money day in, day out, week in, week out. And it's really simple to do, but most people still do it wrong. So the trend is your friend. You've heard this adage. It's an old adage. It's not just a stock market thing. The best traders in the world know this. They also apply it, which is something different to knowing it. Knowing something and doing something are two very different things. And again, the trend is your friend. And it's also very true, not just in trading, it's true in business as well. We're looking for trends, we're looking for themes. We don't want to be involved in fads. For example, a real world example is we don't want to get caught up in selling products. If we had a shop on the high street, the main street in the city center, wherever you are, we wouldn't want to load up on products that we can't sell. We want things that people have a need for, they have a requirement for day in, day out, week in, week out, month in, month out. It's a long-term trend that people want new clothes, new shoes, new foods, diverse foods. They want variety, they want choices. So we're looking for things that are in demand on a regular, consistent basis. That's the whole premise of business. Now, what wouldn't be valuable is if I'd invested all of my hard-earned savings into buying as many fidget spinners as I could, because it was a fad. It was very short-lived. It was a buzz. It was like Beanie Babies in the 90s, maybe Tamagotchis in the 90s. It was fidget spinners. It's whatever the hot thing. I don't know if when I was a kid, it was like yo-yos came back into fashion. You know, it's a very short-lived trend. A bubble is another way of describing it. It was here today, gone tomorrow. Pokemon Go was a recent thing, and everyone went crazy for Pokemon Go. You know, these are all just examples of trends and bubbles. They come and they go, and so it's not what I'm hopefully trying to illustrate. It's not exclusive to the stock markets. And once again, when you put it into context of the real world, of course it's a fad. Of course it's going to be short-lived. Of course it's a silly little thing that's going to be here today and gone tomorrow. You don't think twice about acknowledging these things as not having longevity, a long-term trend. But when we step into the stock markets, we suddenly forget all that. We really, truly forget that the trend is your friend. So we want something with longevity. We want something that is going to be available to us every day. And that's what a trend is. Let me just pause there. Does that concept make sense? I know this is probably nothing new or revolutionary, but I've made a career and, you know, I've managed millions in a fund for using this principle. It's such a simple principle that everyone needs to know it, and everyone does know it, but no one applies it. So let me, while you're kind of stewing over this, the trend is your friend. Famous traders, turtle traders. There was 12 original turtle traders. Ed Sakota was one of the more famous traders. He was popularized in Jack Schwager's Interview with Traders books. The name slips my mind now. He took 5,000 in the early 80s and turned it into 15 million in 12 years. My personal fanboy is Jesse Livermore. There's a whole book. It's my favorite book. It's the best book you'll ever read on trading. There's not a single chart in it. Reminiscence of a Stock Operator. It was first published in 1923 and describes the life and times of a trader who is trading the trend. And he made a career out of it. And when you read that book, you'll discover that very little has changed. Some of the legal aspects have changed and some things you can't do. For example, you could legally market, I don't know why I did the bunny fingers behind the scenes, the camera's not on, and you could go and market a business, which is what a modern day pump and dump is. You would hype up the stock. It used to be legal back in his day, for example. So things like that have changed, but surprise, surprise, they still happen. We've got AMC, we've got GameStop. The same things happen, you know, that did happen 100 years ago, literally 100 years ago. The most famous trend trader that we know is Warren Buffett. Now, this is more of an investment approach to trend trading. It's looking for a company that is a long-term trending prospect, and he's 60 billion net worth. It's undeniable. He made an absolute fortune holding Coca-Cola for 40 years. If that's not the absolute epitome of trading the trend, I don't know what is. Paul Tudor Jones, famous through the 80s and 90s, again, is a very profitable, very successful trader. And one of the things that he was an advocate of is the 200-day moving average. The 200-day moving average is king, is one of the things that he's quoted as saying on a regular basis. He does what we do every week. Thank you, Ezekiel. Market Wizards was the Jack Schwager book. And I think the 200-day moving average, something that we use every week, and we're looking for how price behavior interacts with the 200-day moving average as it moves away from it. It's a rally as it moves, or a sell-off, and we're looking to kind of buy those pullbacks into the 50 and the 200 period moving average. So, we use the same principles. And again, they've managed hundreds of millions of dollars in funds. We've got Bruce Kovner, 5.3 million, John Henry, 2.1 billion, Bill Dunn, 80 million in 2008, Michael Marcus, 300,000 into 80 million. David Harding, his net worth is over 1.3 billion. All of these are trend traders. So what I'm hopefully trying to do is illustrate it works. It's not just me saying, oh, this is my view on the markets. These are people that have made a lifelong career of trading the trend. So the trend is your friend, and the best traders in the world know this. And the first thing that we need to know about trading the trend is that it's not 50-50. This is the single biggest misconception about the markets as far as I'm concerned. Oh, it's 50-50. It's either going to go up or down. And it's not. It is not 50-50. It is not a coin toss. If you think about this for a moment, a stock, a market, and instruments can go up, it can go down, or it can go sideways. It can stay still. There's three things that can happen. It can go up, down, or sideways. And that makes it not 50-50. So as soon as you understand this concept, this principle, that there's three ways for us to make money, then we start to think about the market trends in a different way. Because again, the stock can go up, trending up, it can go down, trending down. It can kind of oscillate. So what I'm going to call a sideways, because the markets are never absolutely still these days. So what I'm going to call a range is where it's oscillating back and forth in a short space of time. And we'll look at this in a moment. And again, to enable us to determine the trend. So the two tips, firstly, it's not 50-50. The second tip, the most important one, the actionable step, is we need to look at enough data. Whatever time frame you're looking at, whether it's a daily chart, a minute chart, a 60-minute chart, a second chart, a tick chart, whatever you're looking at, you need to be able to look at enough data so that you can evaluate the trend. Because I think the trap that people fall into, especially new traders and experienced traders actually, is a multi-time frame approach. Now, I'm not saying that a multi-time frame approach is a bad thing. I do it from time to time. I just think it's unnecessary. When you look at 300 or more bars or candles, however you want to phrase it, on any time frame, it negates the need to do a multiple time frame approach, because you're looking at enough data to make a long-term evaluation relative to that time frame. Again, whether it's a daily chart or a 60-minute chart, I'm a big fan of one time framing my trading. I've done it since 2001. I've always traded one time frame, and it was a little bit out. I was going to say, I'm just thinking about the reason why, actually. I think it was because I was just pretty much lazy. I just wanted to look at one time frame and look for an opportunity. So I always wanted to look at enough data so that I could say what the trend was. Because when you know the trend, and this is the ultimate point I'm getting to, when you know the trend, you know what to do next. You know what to do next. So the trends are trending up, of course. Trend down, of course. Non-trending, ranging, of course. We all know these things, but these are the three trending states. So again, we've got this uptrend. And when you're looking at 300 plus bars or candles, however you want to phrase it, just ignore the moving averages. They're not relevant at this moment. They're just a tool to help us assist what the trend is on average. But if we just visually inspect 300 bars, it starts off at the top, bottom left. It finishes at the top right. It's a fucking uptrend. There is no ambiguity when you look for a trend across the whole chart. Similarly, starts off at the top left, finishes at the bottom right. It's a downtrend. And it doesn't matter whether you've been looking at the charts for 5 minutes, 5 days, 5 years, 50 years. We're all in agreement. When you fill the chart with 300 or more bars, and if it's going up, it's going up. If you explain this basic principle to a 6-year-old, a 6-year-old will be able to outtrade any trader who doesn't do this. Ron, I don't care language. If you don't like the language, that's fine. I am who I am. I swear like a sailor. I'm not shy about admitting it. So if you don't like that, feel free to leave. So trending down, when we know these things, and we're looking at 300 bars, 300 data points, it means that it tells us what to do next. So if again, the two easy ones are buy the dip, because when we've got this trend, we can now say, okay, well, if the trend on the left here is trending upwards, then we can buy the dip. We can say that any downward movement is an opportunity to buy the dip in an uptrend. And that last part is the bit that people forget. It's buy the dip, baby. You've heard it 1,000 times recently. Buy the dip, we've got to do this, got to buy the dip, got to buy the dip. Well, you need to know what the trend is to know what the dip is. Does that make sense? Let me pause there. Does that make sense? Does that make sense? It looks like Ron was offended by my swearing. Well, I think we're all adults here. You know, if you don't like it, just ignore it. Oh dear. Perfect, Ezekiel. Thanks for your comments. So it helps us what to do next. It's the most important, and it's so simple. It really is simple. It's not complex. Can everyone agree that it's not complex? But it's a simple thing. Look at enough data. If it's going up, it's an uptrend. Great. Now I know what to do next. I know what I'm waiting for. I'm waiting for a downward movement in the market so that I can look for an opportunity to buy the dip. Now, we obviously, every week we look at how we define these things. So this is the bit before we've defined the exact, how are we scanning for stocks, how are we finding opportunities. But this is the principle that the scan is based around. And similarly, if we know what the trend is, if we know that the trend is down, we know that trend is down, then that tells us what to do next. I'm going to sell the rally in a downtrend. So all these upward movements are an opportunity to sell the rally in a downtrend. And if you are new to the markets, just understand we can profit from downward movements in the markets. We're not seeing very much of these at the moment because we're just coming out of a huge market crash. Everything's sold off this time last year, so there's very little that's going down at the moment. And the other thing that we might want to consider is, again, and this is, I think this last one, let me just clear the chart up. This last one is, I think, what catches most traders on the wrong foot, non-trending markets. So we'll look at the live charts in a moment. So we're just going through the concepts. So most traders will still have the moving averages on, but they won't recognize that the market is trending. So what I'm typically looking for, as soon as I've got 3 touch points, can everyone see those 3 touch points? So up to that point, up to there on the chart, and off to the left, you would have seen, this is, I think it's Amazon that I took the screenshot of. So you can go look at Amazon, you can go and look at NVIDIA, you can go and look at Netflix. They're all stocks that have consolidated in the last 12 months. But up to that point where you've got 1, 2, 3 touch points there, prior to that there was a trend, but then we've got these 1, 2, 3. As soon as I see those 3 touch points at the same level, they're all exactly the same level, and they can be similar levels, they don't have to be exactly touching, but that's the point where I'm saying, okay, that trend it's changed, it's not there anymore. I don't need to worry about the trend because I've got 1, 2, 3 touch points. And those touch points, price wasn't going higher and higher. It was equal lows, equal highs. So that I don't need to wait for the 3rd touch point, but that 3rd touch point is something that I can trade. So I can say 1, 2, 3 touch points. Great. There's a boundary low. And I can start calling from this point onwards, start calling it a range. Does that make sense? So that it's more about the transition. When does a chart go from trending into ranging? And it's that transition that I was talking about that kind of catches people on the wrong foot, We're going to look at some examples in moments. Another way of doing this is, if you're not sure, maybe you're new to reading the charts, we can use the moving averages to help us with that. So I don't know if you can see on my chart, we've got a crossover, the 20 and the 50 is crossing over. So we've got 1, 2 touch points. So if I see 3 crossovers, so you've got 1 crossover, 2 crossover, 3 crossovers there, and they're all relatively the same level. So at that point, you could say, okay, we've got a consolidation. Now, it broke out very quickly shortly afterwards, so no big deal. But that consolidation could have been like this chart over here, where it consolidated for a long period of time, an 8 or a 12-month period. So we can use the average prices to help us assist with when does it go from trending into a potential consolidation. Does this principle, let me pause here again, mainly so I can have a little drink. Does everyone get the concept? Pop a comment in the chat box. Don't be alone. Don't be isolated. It helps the session. It's really simple concept, and most of you probably know this, but knowing it and doing it are two different things. This is probably the single biggest differentiator that's allowed me to be doing this for nearly 30 years, well, 27 years now, almost 3 decades. It's applying this always first and foremost. Yeah, I mean, Ezekiel, just picking on my comments. Yeah, it's always good to revisit the basics. And I would actually argue you do not need more than this principle to make money. If you did nothing else but apply this, my first strategy was quite literally, if prices above the 100-period moving average, buy pullbacks. If prices below the 100-period moving average, sell pullbacks. That's it. That was quite literally when I, what's it, for the first, so 2000, I was trading for a prop shop, and then went solo 2001. And I'm just trying to think, up to about 2004, I was just trading index futures. Yeah, the point is up for about 4 years, the first 4 years of my career, all I did was these two things. And I was trading index futures. Trading index futures, I was trading the FTSE, the DAX, Euro stocks, on Globex futures. And this was back in 2000, 2001. So all I did was that for the first few years, using 100-period moving average as my reference point on 3-minute chart or 5-minute charts, index futures. And it just works. It really does just work. We don't need to make it fancy or complicated. Now, what differentiated was there was a lot of waste. I was making trades that didn't make sense because, again, our understanding improved. So when I added in, how do I tell when the market's not trending so that I know not to trade the next pullback as it pushes away from a moving average, or the 100-period moving average, for example, because the 100-period moving average, it's going to flatline somewhere around there. Or not quite, but you get the idea. So it was just recognizing that that's not a pullback I should buy. That's not a pullback I should buy. It's just recognizing that, you know what, I need to wait for price to start trending so that I can apply this trending philosophy. So that's when I started to apply that. So after 2004, and for any of my old live trading room people, that's when we were predominantly trading breakouts. So then we moved into trading breakouts as the first strategy. We traded breakouts, and then break up the consolidation because we were intraday trading on currencies at the time. And then we would switch over to buying dips and using Fibonacci and all the other fancy stuff. The point is it works. So I've made a career pretty much off just doing these three things and just recognizing what the market's doing. So with that said, let's go to the charts. Let's take a look at it. So here's what most people do before we go on. Just to absolutely, Ziegel, the overnight trading session. Yeah, the overnight range breakouts. This is what most people do. So putting this into practice, putting this into context, the first thing that we want to do is we want to look at enough data. And I catch people doing this all the time. Now, even though they might have the full chart loaded up, so they've got the full charts, but what they're really doing is they're just looking at the last 4 or 5 days. Even if they've got 300 or 400 bars on the charts, they're just looking at that. And it doesn't make any sense. So if you just looked at the last 4 or 5 days, price is selling off. You could say it's a downtrend. You could say dip. Another mistake that people make is just saying that a down day is a dip. It's any down day is a buyable dip. It's not. We need to look at the context first. We need to know what the trend is to understand if it's a dip worth buying. Well, what if that red day is in a downtrend? Well, we want to sell it. That's what we want to do. So we need to put it into context. Context creates clarity. And to gain clarity, we need to look at the data. So when we look at more data, it's like, well, now I'm confused. Is it an uptrend and it's done a 50% retracement? That would be one thing that people may do. And then when we look at, a few more bars, a few more data points, you might be thinking, oh, you know what, it's consolidated. It's neither trending up, it's not trending down. Maybe we should look for a breakout, or maybe we should draw some trend line. I would say also don't worry about trend lines because the markets are dynamic. I would just pretty much look for horizontal sports resistance. I stopped using trend lines on a regular basis a long time ago, and because they're dynamic, they're constantly changing. It's a discretionary placement. I'm trying to remove discretion from my trading. So what we need to do first and foremost is to look at enough data. And I don't know if you noticed, but the picture on this chart is constantly changing from downtrend to uptrend to ranging, then uptrend, a little bit of a breakout play. And then when you look at, keep going further and further back, and look at more and more data, then we're able to determine what the trend is. And now we can start to look at the kind of the context. Overall, this is an uptrend. You, me, Dupree, we're all saying the markets, this is a Goldman Sachs, if you want to look at it and follow along. It starts off at the bottom left and it finishes at the top right. Great, that's an uptrend. That means that I now know what to do next. I know what to do next. Now, it doesn't automatically mean that any red day, any downward movement is an automatic buy opportunity. But what we want to do is we say, well, if the uptrend is up, we're just quantifying it by saying there's the 200, there's the 50, there's the 20. So as price dips below the 20 and comes back to the 50, then this is my dip worth buying. 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 So it cuts out the noise when we start to quantify what we're doing, because now we know what an uptrend looks like and how we're quantifying it. And we've gone through the rules of quantifying what we consider a trend multiple times in the past. So I won't belabor that right this moment. But it means that I know what to do next. Oh, the chart is up. I should be buying the dip. And the first exercise that I get most traders to do to illustrate this is just to go through a list of stocks, just to look at enough data. Let's practice what we preach there. Let's get, so there's 12 months of data. It's about 250, 300 candles, just for reference. So this is what 300, it's about 12 months. It's about 12 months. So look at 300 or so bars, 250, 300. The trend is up. You should be buying dips. Looking at Apple, it's ranging. It's a little bit messy, but you know what? If it's messy, move on. Now, this thing here, moving on, that's one of the most difficult things to do. When you've got a situation where I'm not sure, maybe the chart is half and half. The first half on the left is messy or ranging. The bit on the right is trending, or vice versa. The bit on the left is trending, the bit on the right. You've got the choice to, I'm not sure. And I think that's the fourth state, or the fourth trend that's not a trend, that we should all consider, especially as new traders, is just to recognize, like, I don't know. And it's okay to say that we don't know. So if you're not sure about a trend, move on. Go and look at something else. So so first exercise that we want to do is to buy it. So here we go. Here's a good example. So Boyd, BYD. Very clear trend, things that we've been following this most of the year. So we've got a Bible dip here. It should have rallied. Now, if the market had carried on moving higher, but can we see that it's now doing something a little bit different? It's not that the trend is broken. It's just that it's doing something a little bit different. But can we now see in the short term, we've got 1, 2, 3, and possibly 4 touch points. So we've definitely got a consolidation there. I still wouldn't sell that consolidation, because the overall trend is up. I'll consider being a seller as price goes below the 200 period moving average. I'm always using the 200 period average as my reference points, my North Star, for want of a better description. If it's above, bullish. If it's below, bearish. We've got other criteria that we look at on a regular basis. But what we're able to do is say, okay, well, there's a consolidation. And in the context of the trend, we should see, my belief is that this breakout that we're seeing here, that should be a false breakout, because the overall money flow, the trend, is up. So I would be looking to be a buyer as price broke back into the consolidation, or as price went above the range. So because I can recognize the structure and not only say the overall trend is up, it's still above the 200 period moving average. So I'm looking to be a buyer. I can start to drill down and say, well, in the last 3 months. We've got this short-term consolidation, and I can put that short-term consolidation into the context of the trend. Does that last part make sense? Where we're layering on the most recent week or the most recent month or the most recent 3 months because something different is clearly developing, but I'm still using it to layer onto the long-term structure of the trend. Long-term trend is up. Great. Short-term, last 3 months, we're always defining the time horizon. The last 2 to 3 months, it's in a consolidation. Great. Okay. So what are my choices? Oops. What are my choices? I can, I don't want to trade bearish. I don't want to trade bearish yet, but I can use that structure to help me identify what I should be doing, next. So let's take a look at Netflix. So Netflix is a good example. So Netflix was, I think, the chart that we used as our example. We've got 1, 2, 3 touch points. So at that point there's the 200. The overall trend is up. So I don't really want to take the breakdowns of the consolidation like we've got here. It broke down, false breakouts. I don't want to do that because the overall trend is up. And I know that if I just zoom all the way out, we can see that we've got this long-term trend for the last 2 years. So the move into the consolidation is up, the trend. The move into the consolidation, we've got 1, 2, 3. So at that point there, that's where we're saying that the average price is, price is developing 3 touch points. So I'm going to start thinking about it moving out of a trending phase and possibly into a resting phase or a consolidation. Now, what I mentioned earlier was we could also use the moving averages to help determine this. It's a little bit longer to do, but what we can see is average price that the 50 period is there, the 200 is there, and that's the 20 is there, the 200 is here. But the average price crossed over there. It crossed back again very quickly, and it crossed back again there. Can we see that there's 320 crossing over the 50s? 1, 2, 3. So at that point, if we use the moving averages, if we wanted to mechanize the process, I've got 3 crosses in my 20 and 50 period moving average in a short space of time, and they're relatively very close together. We can see that visually they are close together. So using the average prices, we can use them to help find consolidations. Average prices crossed over once, twice, 3 times, all in less than 6 weeks. That's if we weren't sure from a discretionary viewpoint here, then we're definitely going to be saying, you know what, something's not quite right. Because if the market's trending, the average prices shouldn't be flip-flopping back and forth. Does that make sense? So we're just kind of taking our evaluation to the, how do we recognize a shift in trend, a shift in direction? Let me pause there. Does that make sense? Everyone happy with that? Using moving averages to help us determine when a range is. A non-standard use of a trending tool. Fab. Thanks for your comments, folks. Awesome. Right, let me just check in. How's everyone liking the session so far? How's everyone liking the session? There's a few new names. We've got one name that's probably not coming back because of my flippant use of swear words earlier. Oh dear, that's funny. I'm expecting a very angry email. Yeah, cheers, Randall. I'm expecting a very angry email later. You know, I always think about swearing. I like to swear. I do. I actually, despite my sweary nature, and I do try to hold back on these sessions, but I think about them like verbal exclamation points. There's no malicious intent behind my use of profanity. And I think that's the main difference, whether someone swears or doesn't swear, because if you've got malicious, not quite the word, you know, venomous intent behind a word or a phrase, you can make anything sound sweary. You could call someone something really innocent, you trouser, but if you But if you put intense venom behind a word, then it's that saying you're angry. Yeah. So, and sometimes you need to vent. Yeah, sometimes you need to vent. Sorry, I'm just taking a moment to myself to reflect on my use of swear words. I gave up on it. You know, I'm not trying to please everyone. If you're offended by it, you know what? There's nothing nasty meant by it, you know. Fuck it, who cares? Anyway, where are we? Randall, it does feel good to swear. I like it. Ezekiel, thanks for your comments. Mark, lovely. And Rob, I know you swear like a trooper as well. Maybe we can hop on the call later and we can just swear and chew tobacco. So where were we? Trending and range. I think everyone's happy with, yeah, I know. I think everyone's happy with when a market is or an instrument is trending. It's going up, it's going down. It's very easy, but it's that transition from one to the other. So I'm just going to put this full screen. It's that transition from one to the other. So as the average prices move back and forth and ebb and flow and rally and retrace, you know, we've got the move away from the 50, in this case, back below the 50, above it. So, you know, we've got those multiple touch points, you know, 1, 2, 3. Generally speaking, if the market is not waving higher, then it's not trending. A trend is defined by prices waving in a series of higher highs and higher lows. That's broadly accepted. It's still a discretionary viewpoint. But again, what I was hopefully trying to illustrate, let me just zoom in a little bit. What I was hopefully trying to illustrate is we can use those average price crossovers to say we've got 1, 2, 3 in a relatively short space of time, both horizontally and vertically. They're not separated from each other. So at that point, we can say, you know what, price is in a range. Mark, don't worry about the sloping highs. Don't worry about the trend line. Just say it's a horizontal range. Mark off the boundary low at that point. Mark off the boundary high, and don't worry about trying to connect the tops here. Because if you did, let me just scroll back the hands of time. Because if you're trying to draw trend lines, and let's just say that we're looking at this, you might be saying, you know, okay, I think that we've got a consolidation because you've got your 1, 2, 3, and then you connect the high there to that high, or you've got a lovely little, oh, it's a triangle pattern. Ooh. And this is the downside to using trend lines. And this is what I meant earlier by the dynamic. And I stopped using trend lines, I'd say 99% of the time, for this reason. It's great that you've got 3 touch points, which is, you always need 3 touch points because anyone can connect 2 points together. But obviously we know what happened with hindsight, but it's that evolution of price. There would be so many people that go, oh, there's the trend line. There's the 3 touch points. There's the break. Yes. Trades, you know, we've got a retracement. I'm not waiting. We've got the retest. We're going in. We're going to make loads of money. It's breaking out. We've got a triangle pattern. We measure the height because that's the usual thing. That's what textbooks say. We add it to the breakout points. It's going to be amazing. We're going to be millionaires this time next week. And then that happens. It gaps down. You know, and this is why I stopped using trend lines and specifically trying to recognize the name of the pattern. The name of the pattern. I don't worry about whether a consolidation, because I know 34 different named patterns and I trade them very, very well. But what I started to notice was there was lots of false breaks. There was lots of what I used to term as an evolution of price. And this is why I always used to add a pullback after a breakout. So just to do the thing. So what we would do is we would add a push and a pullback. It has to retrace a dip on the break, you know, and that's what we would normally look for. And that's why I added a pullback into the break of a consolidation. But even then, there's one there. You would have got a little bit of profit and then it gaps down. You know, I was starting to see the failure of even the breakout type of setup. So I moved to just literally calling it Don't care what the name of the pattern is. Don't worry about the name, whether it's a triangle, an up wedge, down wedge, Elliott wave, 3, 5, some sort of fractal pattern. Again, there's 34 different patterns that I know. There's hundreds of differently named or different variations. They've all got their own rules. Don't worry about them. Don't worry about the name of the pattern. Just recognize the phase. It's either going up or down, or like it is here, it's in a consolidation. No one is in dispute over the phase, but everyone will argue about the name of it. Everyone's going to argue, oh, it's an Elliott wave. Oh, it's a back pattern. It's a Gartley pattern. It's a crab pattern. It's a triangle. Oh, well, next week it was actually a horizontal range. And last week it was this. Price evolves quite regularly. Price evolves. And that's the bit that the textbooks don't tell you, because the textbooks need to teach us one way, and we all need to learn, but we're learning from after the event. What is the completed picture? What's the perfect example of what we're looking at? Because that's the completed picture. And that's kind of like how we look at the markets. We're looking for what's our idealized example of a consolidation, or of a trend, or of a inserts the phase that we're looking for, or the pattern that an author is trying to describe. And that's all we're looking for. So we're always looking for the completed picture. And arguably, this is also why a lot of traders will buy rallies. A lot of new traders, a lot of new investors will do this. They'll see that's the trend, and they'll buy the rally in an uptrend. They'll get in there, and then this happens. The next dip, the next retracement happens, which is what we're seeing this week, folks. That retracement, that correction, that 1 or 2 day correction, and then they're going to close their positions here, and all the retail traders get out at that point, and then the professional traders get back in because they're buying the dip. So it's this ebbing and flowing back and forth that we need to worry about. So this is why we want to recognize the trend first, because no one ever made money buying the rallies. It is possible, we can do it. There's a way of doing it, but we don't want to buy a move that's overextended. And yet many novice traders do that. So that's the trap that we're trying to avoid. And hopefully, after this reminder of the basics that we've gone through today, no one here will be doing this ever again, except maybe Ron, because Ron's left. Because Ron didn't stay for this part. So maybe Ron's going to do it. So no one buys rallies. We want to buy dips. You want to buy things at a discount. And good question from Mark, actually. So only trade the main trend, forget about counter trend. I've traded counter trend. There's a time and a place to it. My argument for not trading counter trend, and it is possible. I'm not saying that it's not a valid way of trading. There's where are we? Where's my little drawing widget? There's 8 market directions that we can profit from, Mark. The first 6 that we've been through, we can trade an uptrend, we can trade a downtrend, we can trade a range, we can be bullish at the range low, bearish at the range high, we can trade the breakouts at the range high, breakout at the range low. So they're the 1, 2, 3, 4, 5, 6 ways that I like to trade. They're the 6 blueprints that I like. But you can trade, as you were suggesting, counter trend. You can profit from those downward movements. And there's a lot of money to be made from counter trend or bearish trade, because the argument for counter trend trading is the market moves down quicker than it moves up, unless it's 2021. So counter trend trading is possible, but my argument against it is, would you rather swim in a river going against the tide, or swim in the sea against the tide or with the tide? I would rather go with the money flow. The money flow is the trend. That's the money flow. The money is driving prices higher and higher. Right now, they're in equilibrium. And there's a way of doing the trade. We can trade the trend off the highs and the lows. And if you're in our community, we've been talking about these trades. We've got we're profiting up and down from these moves on Netflix and Nvidia and some of these trades. I'm actually selling premium on these trades as opposed to trading it directionally. So a slightly different way of profiting from the same movements. But ultimately, we can profit from these directional moves in a short short-term way, even though price is trending. Do I trade counter trend? Generally, no. Generally, no. It's not that it's a bad way of trading. It's just that I don't want to go against the money flow. The money flow is the trend. So if we look at, again, Logitech. So Logitech is what you can make money from counter trend. Clearly you can do it, but you've got to be quick-fingered. How do you know that the counter trend move is going to be over? And it is possible to trade those. It is possible to do that, Mark. I'm not saying it's not. It's just I would rather spend my day and my mornings and my week doing something else than wondering if that retracement is over. I don't need to worry about it. So the trade-off I would say is if you are going to trade counter trend, you've kind of got to keep your finger on the pulse a little bit more than I prefer to do and I prefer to teach. I'm not sure if I've articulated the answer for you there, but I'm just trying to give you a perspective on what I would rather do. For me, it's all about time. I've day traded, I've counter trend traded, I've with the trend traded. What do I prefer to do? I'd rather trade the trend. I'd rather buy the dip, like we do, like I teach. So these are my buying opportunities rather than counter trend trading opportunities. I would rather go the zoo. I would rather spend some time with friends, spend some time with family. Every day I go for probably a 10-kilometer walk. I'm sightseeing, I'm looking around my area. I don't know if you were in first thing on the session today, but I got into the habit of taking a few photos just of interesting things that catch my eye, catch my attention. I met a triple amputee on Tuesday. He served in Afghanistan in our British Army. And I got chatting to him, and such an interesting guy. He's overcome a shit ton of adversity in his life. He's literally got one arm, and he's doing Land's End to John O'Groats, which is kind of like from the north of England to the south of north of the United Kingdom to the south of the United Kingdom. It's the longest distance that you can travel between 2 points without leaving the islands, and he's got no legs. So, it was just a little bit inspirational to meet this guy, just literally randomly on my walk. He's doing a charity walk, and I get to meet interesting people because I'm the type of person I will stop and talk to random people, random strangers, just spend, 5-10 minutes just talking to random people in someone's life. I would rather do that than worry about my counter trend entry. You've got to be a little bit more precision. There's a little bit more refinement on the entries. There's a little bit more refinement on the exits. I'd rather be a little bit sloppy and a little bit lazy and make more money by not stressing and enjoying my life than worried about, did I time my entry or did I time my exit with precision? I hopefully that gives you it's more about the philosophy of how I want to trade, Mark, as opposed to why you should or should not trade. Trade-off is time for me. Time is the most precious thing that we all have. So I would rather be doing other things with my life than flicking through chart after chart and monitoring my positions on a regular basis. Sorry, I'm just catching up on some of the comments, some interesting questions coming through. So, the main trend, Mark, the main trend. It's not that counter trend is a bad decision to make. It's just I would rather go with the money flow. The money makes me money. That's all I can say. How many stocks would I monitor in my portfolio? My portfolio is about 30 stocks. So I've got my top 10, top 20 there. I've got some speculative stocks there that don't have a kind of newish stocks. They've been listed for anywhere from 1 to 5 years. And then I've got a universe of stocks that's about another 100 or so. So my entire universe of stocks is 150, 150. So I'm not looking at every stock every day, all of the time. But if I needed to sit down for an hour and just look at all the charts, it's only going to take me less than an hour. So if I need to spend time at the desk, it's time efficient. Because if you think about how many stocks, I think this is a good question for everyone. A reminder, I'm not looking at every stock every day, all of the time. It's not just a saying that rhymes that I say every week. I want to look at the best stocks that have good track record, that have a historical tendency to trend, like Logitech. Logitech is a good stock for me. And I'm not sure if many people have seen this for a while. I'm just loading some more data. I'm going to load 20 years of data. So since 1999, or as much data as possible. So I've got a lot of data. And I've got a nice little automated version of it. And this is about 90% of the strategy that we have. And there's that 10% that I just can't, I don't, it's not that it can't be quantified. I know it probably could. I'm just not smart enough to quantify the last 10% of my strategy just because I don't know how to explain it to the programmer. That's the only, I'm working on it. I am working on it. But, you know, even without the, that last 10% that's automated, if I was just to take every buy signal and every sell signal without worrying about anything, you know, over the last 20 years, it's got a reasonably steady equity curve. So I know that when I apply money management, when I apply compounding, because this is without compounding, I know that I'm going to start to see good results. You know, so $1,000 risk in, $20,000 out without compounding. So I've got a good strategy so that I know that, if I fuck up somewhere, I've still got the odds of success in my favor. I'm not trying to trade a meme stock. I'm not trying to trade pump and dump. I want to be able to look at this stock and trade it in my portfolio for the next year, the next 2 years, the next 3 years, the next 5 years. And I'll evaluate my universe of stocks probably once a year. So the idea is that I've got a good basket of stocks that have a historical tendency to trade well, to trend well. Again, Apple, for example, we've got nice steady equity curve. It runs up nicely. Of course, it's the darling. It should be in everyone's portfolio. It represents about 12% of the index at the moment. So it should be in everyone's portfolio. And then it's not just my opinion. It's like the data says this continually keeps making new equity highs and has done for the last 20 years. So it should be in everyone's portfolio. Like, this is the sort of equity curve that makes me think, I don't need to put that 10% input into, I don't need to think about the trade. I just need to put the trade on. So that's what I'm looking for, Mark. Just going back to some of your questions. How many stocks do I monitor? How I've created this universe of stocks is with the assistance of my algorithms. You know, the strategies that I teach to all my traders, essentially. It's the classic trend trade. The one that I just showed you there is we don't talk about. It's only my, it basically looks for the strongest trends in trending stocks. But I'm looking for those tendencies that have a regular, consistently and a historical tendency to trend. Again, this just gives me the foundation to work with, so that when or if I come across a stock that I like from, say, a fundamental viewpoint, maybe fundamentally you like a stock. There's nothing wrong with trading those stocks. It's just that you've got something extra to worry about. So, for example, the gaming stocks, Penn State, for example, it's not got a 20-year track record for me to go, oh, this looks historically a great trending stock. But I've got some fundamental additions to say, you know what, there's going to be a lot of positive change in the sector as a whole. So maybe I want to add some gaming stocks because they went around 20 years ago. So I don't have the data to justify. So I can pick up the slack by adding other elements in should I choose to. So just trying to illustrate some flexibility where you can be. So, but trend trading, you're looking for stocks that have long-term prospects, essentially. Picking up on the next part of your question, do I follow trending industries? I think I kind of answered that question without realizing. Do I follow trending industries, then pop the stocks in? If you're going to do that, yes, you do need to look at fundamentals to follow a sector or an industry. Again, another thing that's going on at the moment is the microchips sector is really smoking hot, if you'll pardon the pun, simply because there's the shortage of resources. So those microchip processor, the NVIDIAs, the AMCs, the not AMC, Micron type stocks. So these types of stocks are benefiting from a shortage. So what they are producing is going to be in higher demand, so they can charge more money. They can charge more money is the logic behind it. And then you've got like those types of chip processors. So there's a little bit of situational of supply and demand, fundamental. That's what I mean by fundamental. So you don't have to like research the company reports. You can just go, you know, this sector's looking a little bit hot. Same with energy. Energy last year, there was a pipeline shortage. So you can go, oh, you know what, maybe we should have a few more energy stocks in the portfolio, because that, you know, that kind of pipeline shortage, and then the hacking thing, which created some uncertainty very briefly. It's creating a little bit of excitement in the sector. So maybe, from that fundamental thing that we can see, a little bit of common sense, maybe we should have a few energy stocks in the portfolio. So you can do that. So is there a reason why we don't trade them? How the approach strategy fare against the metals? Long-term, Ezekiel, long-term things like metals markets, gold, they don't stack up well because gold is genuinely a store of wealth. I'm just going to, so this is the gold ETF. So a store of wealth should be stable. So if you look at long-term, so we've had some great runs from 2019, and what you'll find with things like metals is you're going to see trends, long trends, but then you'll see long multi-year consolidations. That's kind of normal. So they're a little bit of a different beast when it comes to things like metals. So for that reason, I'm not going to take every trading opportunity. So the strategy of the stocks that I've picked, I should be able to take every trading opportunity that is presented because the data supports me taking every trading signal. Now, it doesn't on something like gold. It doesn't mean that I'm not going to trade gold or trade metals. It just means I'm not going to trade every alert or every setup that is presented from the algorithm. I'm going to need something extra. I sometimes refer to this as a no and. So this is when I will layer on the things that I bring to the table, my knowledge, my experience, the way that I view the markets. And this is where if you then want to layer on the breakouts and some patterns, or maybe you want to add in a little bit of Elliott wave. I'm not saying that these are all bad things, as I mentioned earlier. It's just that because I've not got the data to support or the strategy, I can't justify taking every trade alert. So I need something extra to pick up the slack. I need that usual discretionary interpretation. I'm not sure if I answered the question there, but yeah, it's a more discretionary approach. It's just, I need to pick and choose which ones that I do. And again, I've got a process for that. Again, we've sometimes spoken about it here on these sessions, but it's just, I'm not going to blindly follow every trade alert that presents itself. I'm just going to apply a little bit of common sense. And all that might mean is I'm going to delay my entries, or maybe I get in on some more aggressive entries. Awesome, Martin. It has been recorded, so if you want to catch up on the bits that you missed, I think you might have already left. One or two people need to pop off. I'm here for you guys and girls. So if you've got questions, happy to continue with the open forum, which is what we've kind of turned in. Really great to see everyone asking questions, which is, from my point of view, it's wonderful to see. If I've missed anything, just repost your question. I'm just skipping back now. Officially, we finished about 20 minutes ago, so I'm just catching up on the lots of questions that we've got this week. So if you need to pop off, feel free to. Mark, so stocks have a tendency to trend Brent. Okay, cool. I think we've answered that one. And Steve, so just catching up to the bottom. I typically send out the replays. So it's a question about where are the replays. Firstly, I've got a community called that's on Slack. So if you go to AntiVestor.com/Slack. So if you go to AntiVestor.com/Slack, I'm going to pop it in the chat box. That will take you to this community. There's a channel there for workshop replays, and they generally go to Facebook. So we've got last week's one where we actually looked over my shoulder and we just got stuck into stocks and just looking for trading opportunities. We also posted some of the stocks that we looked at last week, but you've got all the past ones there. But once you're on the YouTubes, you'll be able to kind of dig into all of the ones that make most sense. There's also some shorter, more condensed topics, like there's 6 trends. I was revisiting it for a more condensed version. So we obviously got the longer version this week. That'll be recorded and available over the weekend. And you can kind of pop in there and kind of get access to it. If you've got any questions, this is the best place to get to me. Just click on my name and you can typically send me a direct message. I'm pretty responsive and accessible on Slack. Mark, I am resuming. So there was I'd just like to say an unprompted question about do I offer any premium services? So it wasn't prompted. I'm in the process of restarting a live trade room. So you've got the inside scoop on that because the question came up. I will be looking to resume it in the next week or two. The only reason why it's been delayed, it was meant to happen last month, but I actually tore a muscle in my shoulder several weeks ago, and it was really painful. And I mean, really painful. Not just saying I pulled a muscle, like it tore it. So I just delayed a lot of things that I've got in the pipeline just while I heal up and rest and relax, essentially. So paid services, I'll be planning an over-the-shoulder swing trading room. You've just missed out on the day trading room, Mark. I spent 8 months late last year and early this year doing the day trading. All it really did was serve to remind me of why I stopped doing it. Yeah, absolutely. Yeah, it effing hurts. And I'm censoring myself because I'll be saying it with a little bit of venom and a little bit of intent behind it because I actually mean to swear in a nasty way. So I'm censoring myself there. So it'll be an over-the-shoulder swing trade program, probably going to be Mondays and Wednesdays. And the idea is you can check in with what I'm trading as I'm trading it, so you can see the entries, the exits, the stops, the targets. And as you can appreciate with a free Friday session, like we only get so much time. I'm not going to go into as much detail. I'm kind of teaching you a little bit as how to find stocks as opposed to what to do when we find them. It's a free session after all. So yeah, it's going to be swing trading, a little bit of education involved there, bring you up to speed of how we actually apply the swing trading strategy, how we find stocks, how we filter them, how we place our entries, exits, stops and targets, and generally how we manage the portfolio, because it's not about the individual trades. It's about how we manage the portfolio, how we keep the money, how we profit from the money. So like the sell-offs this week that we've seen, so we've seen what some of the conversation we've been having. It doesn't look like there was anything to worry about this week when you zoom out, but the sell-off yesterday, the sell-off on Monday, Tuesday, on Tuesday, for a lot of people that was really scary. Seeing that sell-off, yesterday's sell-off was really scary. But to be quite frank, what was I doing yesterday? Well, I've got to admit I was doing something else. I wasn't stressing over the markets because we've got the portfolio is managed. Like the sell-off was actually beneficial. I made money on that sell-off yesterday. Now, keep in mind, I've got a long-only portfolio. Just keep that in mind. I've got a long-only portfolio at the moment, and yet we still made money on that sell-off. So that's the type of thing that we'll be going through in these the over-the-shoulder sessions, over my sore shoulder sessions. It's just how to manage that portfolio, how to keep the profits that we make and not stress on a day-to-day basis so that you can go and do other things. So you can come to sessions like this and then maybe have a long weekend. And that's exactly what I plan on doing. I don't really need to do anything with my portfolio today. I'm going to finish yabbering in just a moment, and then I'm probably going to go out. I mean, it's a lovely day. Again, it's Friday. At this point, I'm usually thinking about something involving ice cream, just to get out the house, because I don't need to be sat here all the time. I try and practice what I preach, which is you should be done in 20 to 30 minutes with the act of trading. In a very short space of time. It should not be time intensive, and that's what I'm aiming to show on these live sessions, as well as the kind of the more premium session that I'll be starting in the next week or three. Ezekiel, thank you very much. I'm just chatting. I'm just trying to answer the questions as they're coming through. I've got plenty of time, so if you need to drop off, please feel free to. If there's no more questions, I'd just like to finish off by thanking each and every one of you once again for your time, for showing up. It really is appreciated that you spend some time out of your day with me every week, so it's not unnoticed. We could all be doing other things, so just some appreciation for deciding to spend it with me this week. So hopefully you got some value out of today's session. We did revisit the basics, so 6 trends, blueprints that every trader needs to know. And it's a really simple concept. If you do nothing else, if I pop off this mortal coil by not looking where I'm going as I'm eating my ice cream in 20 minutes time, and I pop off this mortal coil with all the excitement of the double scoop of vanilla that I've got with the extra flake and sprinkly bits, just trade the trend. Just determine what the trend is. That's going to help you know what to do next. Oh, Columbo question from Mark. One last question. How will you be notified? An email comes out from Zoom every week, Mark. So if you've registered for this session, which I'm guessing you have because you're here, then you'll get notified next week on the next session. So it happens automatically is the good news. So look out for the Zoom. They're every Friday, 9 a.m. Eastern. So it's they usually do happen. So if you're in the Slack community, there should be a notification there as well. Awesome. Once again, folks, thank you very much for your time. Thank you for your attention. Have a wonderful weekend. Make sure that you find something fun to do with your day, even if it's just for 5 or 10 minutes. Go and put some fun in your day, in your weekends. Go and spend some time with the loved ones. And thank you for spending some of your time with me today. Have a great weekend. I'll see you all very, very soon.